The markets are currently closed as we sit here on Saturday, December 13, 2025, but the price action we witnessed during the last session is nothing short of a wake-up call for every single investor holding or watching this ticker. NVIDIA Corp ended the Friday, December 12 trading session at precisely 175.02 USD, taking a sharp hit of minus 5.91 points or a decline of 3.27% for the day. While the after-hours market showed a tiny flicker of movement, sitting effectively flat, that intraday slide is the story we need to rip apart right now. You look at that red number and you probably feel a mix of confusion and anxiety, because on paper the news cycle suggests this stock should be ripping higher. We just had a massive geopolitical development regarding chip exports, yet the stock is dumping. This is where the tension lies. The expectation is that favorable government policy automatically equals profit, but the reality is that smart capital is using that very news as liquidity to exit their positions. Let's be honest about what you were expecting. You saw the headlines, you saw the reports that the administration is finally allowing the export of the high-powered H200 chips to China, albeit with a 25% tariff or fee attached. The narrative in your head was likely simple. NVIDIA gets access to its biggest market again, revenue explodes, and the stock reclaims its all-time highs above $212. That is the expectation. The reality, however, is far more jagged. The market is not celebrating the reopening of trade, it is pricing in the China tax, and more disturbingly, it is reacting to a sudden and aggressive wave of insider selling that suggests the people running the company believe the valuation has peaked for now. When you see executive vice presidents unloading over $40 million in stock in a span of 3 days, you have to stop looking at the revenue projections and start looking at the risk profile. The drop to 175.02 is not a glitch, it is a repricing of risk in an environment where the easy growth has already been captured. We need to discuss the specific mechanics of this sell-off because it wasn't just retail investors panicking on their Robinhood stock trading accounts or checking their balances on the SoFi Invest app. This was institutional distribution. The volume on Friday was over 204 million shares, significantly higher than the average. When volume spikes on a down day, it indicates that large funds, think of the giants managing Fidelity mutual funds or the algorithms behind Schwab Intelligent Portfolios, are reducing exposure. They're looking at the new export rule not as a victory, but as a trap. Yes, NVIDIA can ship the H200 to China now, but that 25% fee eats directly into the competitive pricing power NVIDIA holds. Furthermore, the Chinese government has initiated its own antitrust investigation into NVIDIA, a retaliatory move that could effectively freeze those sales regardless of what the U.S. permits. The market is realizing that NVIDIA is caught in a geopolitical vice grip, and the smart capital is stepping to the sidelines until the squeeze loosens. Let's zoom in on the H200 and Blackwell architecture situation because this is the engine of the company. The H200 is the second fastest chip in their arsenal, and the demand from Chinese tech giants like Alibaba and ByteDance is undeniably massive. We're talking about orders that exceed current production capacity. In a normal environment, this supply-demand imbalance would send the stock vertical. However, we are not in a normal environment. We are in a trade war environment. The 25% export fee is essentially a tariff that makes NVIDIA's products significantly more expensive for Chinese buyers, incentivizing them to accelerate their own domestic chip development or pivot to competitors where possible. The Blackwell series, which is the absolute cutting edge, remains restricted. This creates a weird limbo where NVIDIA is allowed to sell its second-best product at a premium, but the customer, China, is actively trying to destroy NVIDIA's local monopoly via regulation. Investors using interactive brokers trading platforms to analyze these flows are seeing that the addressable market is shrinking, not growing, because political barriers are becoming physical barriers to entry. Now, I want you to comment below how many shares of NVIDIA you currently hold, and be honest, did you buy before or after the split? I want to see where the average entry price is for our community, because that dictates how much pain you are feeling right now. While we analyze the geopolitical chess game, we cannot ignore the internal signals. The most glaring red flag right now is the insider activity. When Deborah Shoquist, the economic vice president of operations, sells $41.4 million worth of stock in a single week, that is not just diversification, that is a statement. Colette Kress, the FC, also executed significant sales recently. These are the people who have the most intimate view of the supply chain, the order book, and the regulatory headwinds. If they are selling at $180 and $175, they are effectively telling you that they do not see immediate upside from these levels. For an individual investor managing their own portfolio on a Fidelity mobile app or using a self-investing strategy, this is the kind of data point that should make you pause. You are buying the dip while the executives are selling the rip. That divergence is historically a very dangerous place to be. It suggests that the supercycle of AI spending might be hitting a plateau, or at least a pause, as companies digest the billions of dollars of hardware they have already purchased. This brings us to the broader fundamental picture. We just passed the fiscal Q3 2026 earnings report in November, and the numbers were objectively staggering. Revenue hit $57 billion, up 62% from a year ago. Data center revenue alone was $51 billion. These are numbers that would have seemed impossible 3 years ago. But the stock market is a forward-looking machine. It does not care about the $57 billion you just made. It cares about the next $60 billion. And that's where the doubt is creeping in. The year-over-year growth rates are mathematically destined to slow. The law of large numbers guarantees it. You cannot double a $50 billion business every year forever. As the growth rate compresses, the price-to-earnings multiple, currently hovering around 43 to 45, starts to look expensive again. Investors on platforms like SoFi Investing and those utilizing Fidelity Wealth Management Services are starting to rotate capital into other sectors that haven't run up 200% in a year. The rotation is real, and it's pulling liquidity out of the mega-cap tech names and redistributing it to areas that benefit from the current macroeconomic policy, which is shifting under the new administration. We also have to talk about the competition, because for the longest time, the NVIDIA monopoly was the only thesis that mattered. That's changing. Reports are surfacing that major tech players, specifically the Mag 7 customers that make up a huge chunk of NVIDIA's revenue, are increasingly leaning on their own custom silicon. You have Google ramping up its own TPU deployment, and even Meta is looking at diverse sourcing. When your biggest customers are actively building your replacement, your moat is under attack. The market is sniffing this out. The drop to 175.02 is partly a reflection of the fear that 2026 will be the year of custom silicon rather than general-purpose GPU. If Amazon and Google reduce their NVIDIA orders by even 10% to use their own chips, that's a multi-billion-dollar hit to NVIDIA's top line. This is why you're seeing that relative weakness compared to the broader market on some days. The AI infrastructure build-out is not ending, but the vendor list is getting longer, and NVIDIA's slice of the pie, while still massive, is being nibbled at from all sides. Let's look at the technicals, because the chart tells a story of exhaustion. The stock has been range-bound, failing to break that 150 to 170 zone decisively to the upside for a while, and now we're testing the lower bounds. The 52-week high is up at 212.19. We are now trading nearly 18% off those highs. For a momentum stock, that is a technical breakdown. The support level around 174 to 175 is critical. We closed right on it at 175.02. If we break below this level on Monday, the next major support doesn't come into play until the 160s. Algorithmic traders and those using the advanced charting on the Thinkorswim or Interactive Brokers platforms are watching this 175 level like a hawk. A clean break below it triggers stop losses, and that accelerates the selling. This is why the intraday movement on Friday was so concerning. It didn't bounce, it drifted lower and closed near the lows. That indicates that buyers were not willing to step in even at these discounted prices. It's also worth mentioning how retail investors are positioned here. If you look at the activity on Robinhood crypto and stock feeds, or the chat boards around SoFi Active Investing, the sentiment is overwhelmingly bullish. The average retail investor believes that AI is the future, and therefore NVIDIA must go up. This disconnect between retail optimism and institutional caution is a classic setup for a correction.